Hi again, everybody, and thank you for being here with us for this panel about a very challenging and interesting subject, primary Grails. How to find, how to buy, how to improve listed assets from listed to private, family-owned and carve-outs. To talk about this subject, I'm proud, I'm honored to have on my left Louis Gaudron, managing partner at Argos with you, which is a small to mid expert on a pan-European scale. So you will have the possibility to share with us your thoughts. Also live on Visio, Tristan Nagler, managing director at Aurelius. Hello, Tristan.
Hi, good morning.
Hi. And Fernando Goni, managing director at Platinum Equity. Hello, Fernando.
Good morning.
Good morning. Thank you for being with, even if you're not here, thank you for being connected with us, and thank you again for the attendees. Introduction question about this subject. Is this period a booster for primary deals and primary opportunities in your point of view? Maybe Tristan first?
Yeah, I do think it is. I do think the sort of dislocation that comes from, a set of circumstances like a pandemic are quite attractive to stimulate decision-making. We very much focus on corporate carve-outs, and we see corporates across the world being confronted with these challenging circumstances and having to reflect on what their core operations are and their core focus, and often concluding that non-core disposals are going to be an important part. So I think it's a really strong environment for firms like ours, and I'm sure for Platinum and for others as well, with the buying opportunity and the sort of dry powder that there is in the market, I think presents a unique set of circumstances.
Thank you. Louis, on your side, what do you expect?
Well, we would expect quite a lot of lender-driven transactions to occur from now on. There's a lot of companies who've been supported by their banks and governments in the recent quarters who have accumulated a lot of debt, and we would assume that a number of those companies would definitely require to move in terms of ownership, in terms of new capital injections, and they will need to move in the next quarters. So we would really expect the next quarters to be very rich in this lender-driven situation.
And also we've talked about the famous now zombie companies during the preparation. It's a potential bomb for the next years and in the next month. Not right now, as you told me.
Yeah, this concept of zombie companies who've been through the crisis with the help of the governments mostly, and who are surviving today, but have a very imbalanced structure of financing as of today, with no net worth anymore, for instance. There are many of these companies actually in the market, and a good number of them are worth supporting, because it's not because they've been unlucky enough to be in such or such situation during the COVID crisis that they don't have a bright future. And we would expect many of these companies to come to the market in the very next quarters.
We'll see then. Fernando, I think you had some thoughts about this first question.
Yeah, look, I agree with what has been said. I think there's clearly a timing issue here. As we entered the crisis, it was very clear that people were looking for liquidity quickly. Those who needed it and couldn't get it from banks or other sources tried to do carve out. But a lot of corporates that were not forced to do it, they wait, right, on those strategic decisions. And I think as we move forward and valuations have held up, we're going to see more of those coming over, much more. I think there's been a lot of processes that have not been pushed through or have been delayed. And secondly, I agree, as the financing changes, there's going to be a lot of companies will need to be put in the market. There's going to be a lot more activity going forward. The carve-out activity has not been very strong.
So an increase of this kind of deal is expected, not right now, but in the next month, give you some time to get prepared. That's good. To get prepared because actually it's like chasing mammoths because primary deals, it's engaging special targets, with special process. How and when, Louis, to start with you, do you see the process and the primary deal origination and transaction?
Yeah, you're right in saying that primary transactions, primary Grails, are pretty different from secondary transactions, and they only make a minority now of the market, but it's a different minority, I have to say. And they require much more involvement from us in the primary funds teams than normal transactions or secondary transactions. Why that? Because first of all, you would find companies which are not always very well prepared for a transaction, not always very well prepared to become PE owned. And so you typically have to structure your transaction with imperfect data, or sometimes not even all the data you would require. So you much more work before the transaction occurs, and then much more work afterwards, because very often these transactions, and that's why they're attractive, they have a lot of value concealed in them.
Hidden value.
Yeah, hidden value that you would like the company to express, and that requires a lot of work. And at the end, all this makes it, I would say, a different job from doing secondary transactions with different know-hows, and I would even say different key success factors. I mean, it's not always being the fastest, it's not always being the one who can raise the more debt that makes you the best primary investor.
Tristan?
Yeah, I tend to feel the same as Louis. You know, I think the buying process, even if it's in an auction environment, it's still not always straightforward compared to a secondary transaction. You know, the standalone financials and the kind of perimeter of the transaction is sometimes well set and well prepared, but more often than not is maybe even changes during the sale process. You know, the corporate vendor, when you're buying a Carve Out, for instance, extra sites, extra people may be added or taken during the transaction. So sort of setting the perimeter is an exercise. And then, you know, actually facilitating the transfer of the ownership. So understanding the setup required for the new company, the new brand, all those things require quite a lot of thought and preparedness. And so I tend to find, yeah, the transactions may take a little bit longer to get done. And then, you know, as Louis touched on, as soon as the transaction is done, you know, the new world begins outside of the corporate home, and the business has to stand on its own 2 feet. And as well as having to set up standalone functions and capabilities to exit a transitional arrangement, there's also everything needs to be thought of. It is a bit like an orphan probably leaving the home. We talk about these as orphaned assets and corporate orphans. They need to think of everything for themselves for the first time. You know, their treasury capabilities, their finance function, their HR, their IT, and so you have to make lots of decisions quite quickly to set up the business for the next phase. You know, hopefully for a phase of growth. And you know, at the same time, you know, you do have obligations to the buyer, maybe to a lender, to service and deliver, you know, covenant compliance, performance, and generate cash and all these other things. So we tend to find at Aurelius it's probably a couple of years of quite involved participation, and we could not imagine doing one of these primary deals and just putting the business on the shelf and coming to board meetings once a month. That wouldn't work for us. We tend to feel that you need an operationally engaged focus for at least the first 2 years to really settle the business and guide it, and then hopefully it does in the end deliver those returns that we aspire to.
Fernando, do you feel the same about this question about the specific and special targets?
Yeah, look, fully agree with what was said. I think the key word on the deal itself is preparation and level of preparation, right? I mean, that dictates a lot of how, you know, we look at these deals. And if you do a lot of carve-outs very quickly when you enter these deals, you realize, okay, what's the complexity of the carve-out and what's the level of preparation that the seller has done. And that's pretty key in order to understand, you know, the resources you need to put in the deal. And also, very importantly, the relationship with the seller advisors, right? Because sometimes you realize quickly that the Carve Out has not been as well prepared as advisor for the seller thinks it had. Because there's, as Louis and Tristan mentioned, there are a lot of moving parts on this, and depending on the complexity of the Carve Out, there may be a lot of items that only get quantified later on during this journey of the deal. And I think that is really important to realize quickly and to be very transparent and direct in terms of, look, these are the things that will need to be addressed. I think there the key afterwards is to be also a partner to the management and the seller in that process. Sometimes these things take time, and they become bilateral discussions, because you need, if you haven't really prepared properly the cargo, you need to work very closely with the buyer to put all these elements in place that take time. And I think that that's critical also going forward. As as Tristan mentioned, a lot of the times they're much more hands-on post-deal, because there are a lot more things that need to be done. This has not been a standalone company, etc., etc. But that, for us, a lot of that needs to take place during diligence, making sure that you align. And obviously, afterwards, things change and you need to adjust. But yeah, there's a lot more complexity, and look, that should also create more value opportunities.
Thank you, the three of you, for this introduction of the comprehension and understanding of such targets. Now, if we have to go in details in this in these deals that represent higher investment, as you said, in time, in resources, maybe in money. But we will try to answer this big question. I'm sure you have all the good answers. Is do they also come with a better returns? And to start to answer this question, maybe we can talk about the risks and challenges that you have to face while investing. The first one you told me about, Tristan and Louis, is the cultural change and harmony to find and implement in this JV that is created while carving out. Louis.
Yeah, that's true that one of the very important success factors we need to tick in every single primary transaction is to be successful in the cultural change from the previous culture of a family-owned business or a subsidiary, and sometimes an orphan subsidiary of a larger group, and to bring a culture which is ours in terms of being result-driven, being very cash and value generative. And that is a change, and we have to do that in a way that keeps the people involved, and a buyout and a leverage buyout should also be a sort of a liberation buyout, so sometimes a moment where you bring new energy. But we also need to manage cultural resistance sometimes, and to manage it with some decisive but also careful actions. And we also need to manage the anxiety, because no company I've met is welcoming without a little bit of anxiety the fact that suddenly a fund will become the majority shareholder, will bring new rules, new ways of thinking, and this we need to manage as well.
Fernando, on the same question about culture.
Look, absolutely. Those points are very, very valid. And I think in a lot of cases that changing culture is daunting for a lot of the employees, and for all the right reasons. You're part of a very large corporate, that change into private equity hands is something that people are not really accustomed, also in family-owned businesses. So it needs to be dealt with very, very carefully. Again, the intensity of the ownership might be different. The way that we look at things might be different. So I think that aligning interests and making sure that you're very clear on how the new path will look like is important, and being flexible there is really key. And I think a lot of the times that is the case, that you have, in carve-outs, non-core non-core asset with the management team has not been exposed to these things, and also employees, and they go on to a new journey. There are also cases where you have a non-core asset where you have a very good management team that has felt that they haven't had the right capital structure, the right access to growth opportunities because they couldn't fund them, or a more dynamic owner, and you untap a lot of value in that organization, and you carve out that company, and they absolutely flourish under more a different ownership structure. I can think back to when we carved out Sargent Com from Safran, and that was exactly what happened with that management team. So I think understanding the cultural implications of what you're dealing with is really important in terms of how you approach it.
Aligning interest of new ownership, new owners, new shareholders with the team, with the top team, but also the whole team, with all the employees, it requires a lot of leadership. How do you know, Tristan, maybe on this cultural change question, how do you know if in the activity, in the subsidiary or the specific activity in a whole firm, you have already the leaders you need, or if you have to find some away or bring in some? How do you know? Because the three of you are experts, investors, of course, very good and creative on the operations. But here we're talking about something more. How do you find your answers about leadership?
Mm. Well, obviously, we have this due diligence period to get answers, to ask questions to get answers, and I guess the answers can be revealing. In normal times, we have moments of intimacy and contact and informality to get to know people. There are firms who do a lot of management assessment. Many of us are just doing human assessment, but you can use all sorts of machine analytics and everything to assess how they will react in circumstances. But I think the best way is to actually complete the transaction and to be open-minded. It's quite easy to have a mindset that this management team won't work out. They won't cope with change. They won't cope with an entrepreneurial overlay and a sort of taking responsibility for everything, which is what they're going to have to do, and a focus, as Louis said, on profit and cash and efficiency. But many people, really surprise you in these circumstances, and they're just waiting for the moment when that responsibility is given to them. They don't want to be part of a big corporate group, and they really want to be empowered. So I guess to some extent we empower, and you see what happens. And you obviously hope it works out. If it doesn't, it's not the end of the world. People move sideways and other people come in, and you have to refresh though. I mean, we all of us, I think, as investors, you're really ambitious for these businesses. We're invariably taking businesses and looking to inject strong momentum and growth and dynamic change. And it's probably unrealistic to think you can do all that without changing things. Like if you're an athlete and you're trying to get faster, or you're looking to climb a mountain or something, you have to expect to take on newness and bring new ideas and fresh approaches. So I think we're not scared of change. And I guess in these sorts of transactions, carve-outs, these sorts of deals, it's probably not so much backing management. I mean, I love the idea that management will be there and we will back them. But in reality, we are backing many of the attributes that the business has, and its market position and its critical mass and its stakeholders that give it real inherent value, intangible value. And in reality, we really hope and we really bring the best we can bring to help the management be successful. But we can't assure it, and I guess if necessary, we will supplement and augment.
Louis, you wanted maybe to...
Yeah, what Tristan said is very interesting, because finally the difference between doing primary deals and secondary deals is whether you like change or not. If you are a primary investor, you have to love change and to be happy to change things, and then you will create a lot of value. While in secondary transactions, of course, there continues to be transformation, but you're more in a change-adverse situation very often.
And the operational, so the first one was a cultural challenge. We were talking about challenges and risk in carve-outs and primary deals. There is a second challenge. It's of course the operational challenge, but how to improve operations when you are already changing so many things? Tristan, maybe to start.
Yeah, I mean, our firm, we're quite systematic in this. You know, you can, in the due diligence and the buying process, dissect a business from top to bottom, and you work out what it does well, what it doesn't do well. If it has a market position, it's obviously doing something well. It might have amazing product or service, but there's something wrong. You know, there's some reason why the corporate owner doesn't want to own it any longer. It might be financially driven. You know, they just need to delever. They need to throw off some ballast to get higher, but it's usually because they're not very satisfied with it. There's something inherently wrong about it. It needs investment. It needs something fixing. So during the due diligence process, we will be quite systematic, and I guess immediately after the acquisition, in a structured, pacey way, but not you know no madness. We will, I guess, intensively dissect the business and effectively go point by point. You know, look at procurement, look at supply chain, look at what it's doing in terms of its manufacturing or proposition delivery, and then look at the distribution, the logistics, the fulfillment, and look at the back office and go point by point. Obviously, the front office activities are critical, I guess, to the core economics of a business, but the back office also needs to be streamlined and attuned, and in a systematic way that is, you know, deeply analytical. You know, you identify, you know, performance improvement measures, and it derives, you know, a set of measures that over time need to be improved. Now, you can't always improve things immediately. You know, you're in contracts that are fixed. You maybe need to wait till those change, or you go and talk to those stakeholders, those customers with whom you're not making any money, and you know, have the discussion. And if you can't get out of them, then you have to be patient. Similarly, the suppliers, you can't just change supply terms overnight. You need to gradually evolve. But you know, there's always benchmarks. You know, that's the important thing. You know, the reason we're spotting these opportunities and pursuing them is because we're benchmarking these businesses and seeing that there is high potential for a great player in this industry. There's nothing inherently wrong with the industry. This business is not at high potential. You know, it's high potential, but it's not at high performance. So our objective during our ownership, you know, the years of ownership, is to take businesses on that journey to make them from probably profitable underperformers to hopefully the best in class. And that is not a quick fix. That is not, you know, none of us, I think, do dramatic, you know, quick fixes. Most of these are detailed, you know, mature approaches to performance improvement. And if you do that, you actually give the employees the best home for working for the rest of their lives. You give the business massive continuity. You make its stakeholders really cherish it because they know that they're dealing with a really high-class operator. So it's very much a win-win, and you can really transform relationships with unions and works councils by going through that journey, investing as you go, recapitalising the business and generously supporting it. And that's the perfect situation. And when we've done that, it's incredibly satisfying when you think of where you started with this unloved, underinvested organisation that had market share but was probably in danger, to something that really is deserving of, you know, is winning market share.
We, from bidding to exiting, but from bidding, how do you understand this operation? There are so many things. How do you tackle this issue?
I would really concur with what Tristan said. I mean, it's analytical, it's setting a pace which is the right pace, because very often, and when you deal with especially family-owned businesses, the last two transactions I've made were with family-owned businesses which have been in the same family for 120 years. So the number of things to change is pretty high, as you can imagine. And then you have to be realistic and understand that the management team and the whole, I would say, organization cannot absorb more than a certain level of changes. So it comes with making a priority of the low-hanging fruits. It comes also with strengthening the management team, adding more resources, more bandwidth to manage more projects. And make it realistic. I mean, well-paced, but realistic at the same time.
Thank you. You've been talking a bit about, the three of you, about maybe a longer period to buy, a longer period to host in the portfolio. Tristan, all this challenge implies a longer period of detention.
Not necessarily, but I think, you know, you made a point earlier that it's important that you don't overwhelm the poor business during this change period. You know, you have to there's a bit of trauma as you bring the business out, as you transact. You know, I think everyone will be familiar with the fact that during the buying process, there's quite a lot of distraction. It's really hard for management to sustain performance, but let's say there's sustained performance. Then immediately after the transaction, you know, you reassure all the stakeholders, you know, it's all going to be great, new owner, but there's still a lot of change. You know, maybe there's carve out actions and there's standing alone actions and there's rebrand. And then you sort of start trying to, you know, improve the business, and you've got to make sure that you're improving it, but at the same time, you're consistently delivering service to the customers who you actually want to keep, and keeping a relationship with the suppliers who you actually want to keep, and maintaining confidence of the employees you want to keep, because it's a very insecure moment for people. So it naturally means, you know, you can't change too much simultaneously. You need to be quite structured and thoughtful about that. And so it sort of tends to lead to maybe, you know, a longer holds rather than shorter holds. But at the same time, I guess partly because certainly we would not be chasing growth, let's say in the first year, when there's all this going on. You know, would you be setting massively ambitious sales targets for the sales team? No, probably you'll be actually looking at the sales structure and thinking very hard about setting the incentives right, and thinking very hard about the sales approach. Would you be chasing massive contracts? No, probably you want to fix the basics, make sure you've got a very, very strong platform, and then go for growth. So as a result, typically in our I guess investment period, there is a period of sort of fixing the basics in phase one, let's say, and then phase two you're going for growth, and then, you know, you're layering on acquisitions and doing the buy and build. And so probably it leads to a slightly longer hold rather than a shorter hold. But, you know, it's you know, there's always an economic judgment, and if you get an approach from somebody who really wants the business in year 2 or 3 or 4 or something, if they'll pay you tomorrow's value today, brilliant. You know, the market sometimes supports that. But if ultimately they want proof of concept and proof that all these are sustainable changes and are robust, then frankly it becomes a slightly longer hold. But we're pretty relaxed. I mean, the main thing is, you know, you have a journey, you have a lot of ideas, and you really do want the time to implement them all. It'd be a real shame if you fix the basics and you don't actually prove that you can grow the business, or you grow the business but you don't prove you can do any M&A to augment the capabilities of the business. You know, you really want to ideally have the whole process proven.
Fernando, on this question of period of ownership?
Yeah, for me, it really varies. It really depends. I think the key for an investor on both on family-owned assets, but especially on carve-outs, is really good preparation. You know, what Louis and Krishna were saying before, both on the carve-out itself, making sure that you prepare as well as you can. And, you know, similarly, we have a playbook of all the things that we do on carve-outs and the areas that we do on diligence. We have an operations team that focuses on diligence and develops the blueprint. And then we have another team within that operations organization that deals with implementing that plan over time. So on the one side, yes, you have a very detailed plan, things change afterwards, but it takes usually longer to execute on all those initiatives. And it depends on the quality of the management team, the help that you can give them. We also, you know, implement changes and add resources to drive that value. So that plays for a longer hold. But, you know, a lot of the times, a lot of value is created on the carve-out because people know less initially of what are the, you know, real value drivers, and you might get, you know, doing diligence or even after holding the closing that there are pockets of value that you didn't realize, and that accelerates the whole period. But I think even more importantly, on the more complex carve-outs, you might see a financial buyer like buying that asset because it's too complex, or a strategic takes too long. So there's value creation in that as well. Like Tristan said, you know, you might have carved out an asset which fundamentally is a very nice asset, but was very entangled into the corporate, and a lot of things you need to change, make it really stand alone, and that takes 1 year. But once you've done that, you unlocked a lot of value for strategics to take a look at that asset, and you might find yourself selling that asset much quicker. So I think it's really situational for me in terms of how you, and there's much more, what I would say, which really applies to carve-outs, is much more uncertain, the whole period that you might have on a secondary asset or tertiary asset that people, you know more. You know, you pay X, leverage at Y, and here are the potential buyers.
Thank you, Fernando. Now, we've talked about the challenges, some of them anyway. Very simple but important question. Is it worth it? To fight so much, to find these deals that are hidden, to identify hidden value to create, to tackle cultural, operational, financial, of course, and vision change in such a short time and with such an intensity. Is it worth it, Louis Gaudron?
The answer is yes. In more details, I mean, the returns are very good, first, and I think that deserves already all the work and attention we pay to these transactions. Second, the risk, in our view, is not greater than in a normal transaction. It's not because you have changes, and we are bringing changes in primary deals, that it creates more risk. I mean, the concept that risk is related to change is wrong. You can then think in terms of psychology and philosophy what it means that people are scared about change, but I mean, life changes, markets are changing, we are changing by every minute. We all would like the time clock to be stopped from time to time, but it's not how the world works. And so change is creating value, and change is protecting against risk. And the past year has shown us that dreaming of stability and having all things continuing as we'd like them to continue is wrong. So there's not more risk. And I would say, lastly, and very importantly for us, there's more fun. And it's really very exciting to accompany those transactions, to make them happen first, and it's always a challenge to do these primary transactions, these complex carve-outs, and then transforming those businesses is a lot of excitement and is very satisfactory to us as teams, as people.
Tristan, in this simple question?
Yeah, I completely agree. I mean, I think first and foremost, this is really stimulating. You know, for professionals like us, you know, it's not a pure transactional business. It is, you know, intellectually and emotionally a journey, and it's incredibly satisfying, I think, to conclude these sorts of transactions. You know, the ability to provide a home for a business that sat within a previous ownership structure that was very, very different, like a corporate owner or a family owner, and to bring it outside and to be the first institutional owner of the business is really a brilliant opportunity. And then as you rebrand the business, you redefine it, and you have a chance to build a brand identity for the business and a new personality. And then you watch it hopefully flourish. And when at the end somebody else takes it on and takes it to a new level, you feel incredible pleasure and gratitude. And I come back to the concept of this sort of orphan, that you're giving a home to this orphan business and giving it a real personality, and you're so satisfied when it continues to flourish and grow under the next owner, and you feel you played a really important part and pivotal time in the development of that business, and you're doing a lot of the hard work that the next owner won't have to do. You're doing all the standing alone, the optimization, the performance improvement to get it to be brilliant, and so it's hugely satisfying, and the economics are obviously effective because you're often buying something that's very difficult to buy. As Fernando touched on, you know, if the preparation hasn't been great, it is a hard buying process, and therefore typically it's often a value type investment on the way in. And when you sell it as a much more perfectly formed business that's much more easily understood and transacted, you will often get some strong multiple arbitrage. And at the same time, if you've also worked very hard to get the business to be performing as opposed to underachieving, you know, really overachieving hopefully, or performing in line with its peers, you end up with a very strong return on capital and return on investment. So it has that benefit as well.
Thank you, Tristan. Fernando, same views?
Look, very, very much so. Very fully agree with the comments made. There's a human element to it as well, right? I mean, when you carve out for the first time, even when you buy a family-owned asset, but when you carve out and you back yourself and the management team and the employees of that division, which might be an orphan division, as Tristan said, and then you see it through, you create, you do the hard yards, and then you end up having a successful exit. And that management team and those employees will always remember that first carve out. and those bonds stay over. But the returns are there. The one thing I would say, which is obvious, is it's not for everyone, and you need to have that experience, expertise, and resources to do these complex transactions.
So we figured out that these type of assets are challenging, but also they come with great rewards, qualitative and financial rewards, the ability for the teams to work in such a creative environment, in creative missions. So now we all want, me and the people watching you, we all want to come with you in the next deal, and now we are trying to understand how to buy one. The first question is how to find one. Because when you do secondary deals, it's not very hard. You take the country France Invest organization. You go in the directory. You find all the funds, and you check out the portfolios if you want to do your shopping list, and you make it like that. But if you're talking about buying for the first time as a company, a family-owned, a listed company, or a subsidiary hidden in some countries in a very big group, of course, it implies huge investment or in terms of origination and sourcing, huge presence on the market, I guess, and long-term presence in the market, because again, a Carve Out, you told it takes time to prepare, it takes time to do. So I guess you don't wake up in one morning and say, I will now do a Carve Out. Louis, on this question?
Yeah, I would say that at least at Argos, we are not so much focused on trying to preempt transactions, and we do not have such a lot of I would say proprietary transactions. Maybe my colleagues would have a different strategy. We see quite a number of opportunities in our markets, not only in France, but in Germany, Italy, and in neighboring countries. And these are quite often intermediated processes, but they remain complex. And that's where we believe we can bring value and avoid heated auctions, because we were not in these heated auctions, because the transactions are more complicated. They require more time to analyze, more time to deliver. Our average time to complete transaction is 1 year, and that's pretty different from secondary transactions. And yeah, that works this way for us.
But surprisingly, isn't it better to be in an auction with many people, in a contest with many people, with many bidders in carve-outs, because it means that the target is ready. It means that the target, it's a serious deal, and that it won't break before the 5 minutes before the end.
Yeah, but now when you look at what it means in practice, and Fernando described it very well, saying, I mean, a carve-out is always poorly prepared, because there are many tiny operational things where about the IT, about the employment contracts of some people that you need to change, etc., that it doesn't fit a wide auction. I mean, to have a real competitive auction on anything, on the pen or on the company, you need to have something which is easy to understand, well defined, on which you put a price. What we're dealing with, I think the three of us, is anything but a simple object.
And how do you, by design, primary deals are hard to understand, because the information, the data is not visible, it's not public. How do you gather all this data?
By long processes with the management teams, because we need to build a solution. I mean, very often a primary transaction has to include a component of being a solution bringer, because there's an issue about the brand, about the change in management, about something. And that requires a lot of work. The data is, you're right, not always very well prepared. And you need to spend quite a lot of time that goes way beyond just reading a vendor's due diligence report. You really need to dig into the data to understand the company, to understand the pros and cons, and all the elements that make the business to find the right solutions.
Tristan, on this subject of origination, how do you chase targets? How do you organize your sourcing?
So, I mean, we're very focused around the corporate carve-out channel. So, we are mostly expecting corporates to want to run some sort of process. I agree with Louis that they're not usually, I guess, hot auctions. They're more difficult. They require a lot of preparation, and they're more for specialized investors. But there are, I guess, across Europe, a lot of auctioned corporate carve-out situations, and they are, mandated to banks and corporate finance, M&A boutiques across Europe. And I guess we are organised geographically and covering the whole of Western Europe. And systematically, we are talking to all the investment banks and all the M&A boutiques on a regular basis. And as a result, we're driving a strong deal flow. And then in addition, it's obviously very, very straightforward to go directly to corporates because corporates are constantly communicating their intentions. They're publishing their financial performance, they're publishing their prospects, and they're identifying strategic reviews and non-core disposals or non-core assets. So it's probably that approach, and then from time to time there are actual individuals, there are management teams looking for the opportunity to take the business out of the larger corporate home, and there are other stakeholders like lawyers and lenders and other folk who sort of stimulate this deal flow. But as such, therefore it's a well-established market, and I think if you're systematic in your approach and you have a developed brand proposition and credible track record, you should get on your table, a good volume of deal flow. We focus mid-market, so we see lots, probably hundreds of mid-market carve-outs every year, and then it's a question of prioritization and distilling to identify those which are sweet spots for our particular investment criteria that are going to go the right way, that we have confidence in winning, that we see all that potential, that are of the right size and complexity, and then prioritize those in each year, try and transact a certain number to be consistent with what our investors expect of us.
And is there any, you spoke a bit about your criteria of selection. Do you have no-go criteria, Tristan?
Yeah, I think everyone does. I mean, fundamentally, the objective, as we talked earlier, is to have fun with these things, but ultimately, it's also to drive returns. So I think an important criteria is a belief, high conviction that there's returns to be had. So your returns are hurt if you pay way too much for a business, and if somebody else wants to pay way more than you feel the business is worth, that's very challenging. Or if you feel the combination of the purchase price plus all the investment capital that's required to drive the transformational change leaves you with no prospect for a meaningful return for the risk involved, this is a risk-return business. So those are pretty important. And then naturally, there are going to be sectors that are more difficult, I don't know, defence maybe, or those which are a little bit sort of at the extremes of I guess, commerce, a bit more difficult. Or there might be difficult geographies. And I guess fundamentally, it's probably for us potential. If we're just not convinced, just because a business is not performing as amazingly as it can, if your assessment is it just can't, either the market is just difficult. No one's making money in this market. It's a declining industry. That would be a very difficult environment. So the reason we won't want to buy businesses in certain industries is belief that they are in sunset industries. I think we call it long-term declining industries.
Fernando, on this question of no-go criteria and time.
Yeah, look, we are quite agnostic in terms of sectors. I think, the way I look at it, if you're doing carve-outs, there are probably industries where you have less propensity and a much higher bar. But at the end of the day, on complex carve-out, we are solution providers, right? I think all the speakers they would agree on that. So we're quite agnostic, but I think what is really important is to be able to quickly realize and decide on which ones you're going to spend time on, which ones you're not. And even being agnostic, you're going to develop a quick view on, look, I think this is an asset where a risk return looks like a place where you're going to spend time because, as Louis and Tristan said, these things take time. You need to apply resources accordingly. So we don't have any, probably absolute no's. We have industries which we've done much more than on others. And then a lot of it as well on the complexity of the carve-out competitive will be how complex it is, how well prepared is it, and am I going to spend time and drive that solution as well.
Thank you, Fernando. So we've understood a bit better this asset class, we've been through the process, we bought the company, and now we're on day one of ownership. Louis, what happens just after the deal in a carve-out or a primary deal?
I would make a big difference between a carve-out and a primary deal, because a carve-out really is a sort of joint venture between the buyer and the seller. Of course, there is a discussion about price and conditions, but once you've agreed price and conditions, there's a whole lot of very practical things you need to agree upon. If, for instance, you, for a transitional period, need to share the IT system, how does it work? What does it mean? And of course, you have discussed that before the transaction, but then you need to operate it, because it means sharing data, sharing cybersecurity concerns, sharing a lot of things. Same with the factory. I mean, how do you handle workers' security, insurance, and all sorts of stuff? So there are so many practical things to handle that it really has to be done in a very collaborative way with the vendor, and you need to cooperate to manage those transitions in carve-out. Sorry. For primary transactions, when it's, for instance, a family-owned business that you have taken over, then you really are focused in launching the 100 plan or whatever plan we have, and starting from day one, the transformation, which again comes very often with making sure that the anxiety is dissolved, because there's some anxiety. I mean, I have had workers in factories crying, and you need to reassure them, tell them it's not the end of the world, it's the beginning of a new era on the reverse, and immediately start the process and make things go from day one at the right pace.
Thank you, Louis. Tristan?
Yeah, probably not much to add. I think Louis covered it.
We've talked about this, and maybe Louis talked about that too, just a second ago. The spirit of collaboration you have to impulse. We come back again to leadership, which is, I think, very pregnant in all this team. How this spirit of collaboration impact the first 100 days, and do you have specific matters to take care of? Tristan, maybe.
Yeah, I mean, I think the collaboration goes many ways. I think there's obviously a collaboration between investor and management, between, I guess, employees and management, but also, I guess, between, as Louis touched on, vendor, the relationship between buyer and seller. And that is obviously very important in the first 100 days, that the seller continues to provide the support that they say they will. Things like transitional services agreements, it's critical that everyone works hard and is well aligned, that they're transitional. The seller would like us to get off them as quickly as possible, and I think we would like us to get off those transitional arrangements as quickly as possible. So I think those are critical for 100 days, but I think many of the transactions we do, the seller is also wanting a future relationship. So they may want to trade with the business on an ongoing basis. We've had that. For example, we bought a business from British Telecom in the UK where they want the business that we bought to continue to service their vehicles. And vehicle service is not critical to what they do as a telecoms company, but it's critical to their ability to deliver telecom services, is that they can actually get engineers where they need to go. So the collaboration actually is hopefully perpetual. I mean, certainly many years of collaboration, trading collaboration. And another transaction we did with a packaging group was we bought the company, but the supply into the company was coming from the seller. The seller was going to continue to supply raw materials into the company. That was important to them. They had a sort of a well-established supply chain and valued that relationship. And for us, I guess, being the new owner of the business, we didn't really want to have to reconstruct a supply chain on day one. It's great to have 2 or 3 years of, I guess, continuous support. And by the end of that 3rd year, I think we figured out what we needed to do to build our own supply chain. We had the capability, and it enabled us to then go to market and to be sophisticated in putting in place a new supply chain. So I think it's so important to buy in the right way, so that the seller and the buyer feels there is a fair transaction, fair value, a fair contract, and that then drives a spirit of cooperation into the future. Because I think every seller wants a fair value, but they also want the business they sold to thrive. They also don't want to be embarrassed by doing phenomenally well, and they don't want to be embarrassed by doing phenomenally badly and failing. So So, and that fair approach, is often underpinned by contractual support that comes from the deal.
Thank you, Tristan, for this good conclusion. Thank you, Fernando Goni. Thank you, Tristan Nagler. Thank you, Louis Gaudron. I've been very happy to speak with you for this hour. I recommend you to stay tuned because a new conference will start in a few minutes. Thank you again. Have a good day. Bye-bye.
Thank you.
Thank you. Thank you very much.
Thank you. Bye-bye.